Hacking Wealth. Little-known strategies to multiply your money. Written and published by Tony Creed. This audiobook is designed to open your eyes to strategies that the wealthiest individuals use, which the average person may never think about. Instead of simply working harder, saving more, and following the same well-trodden paths to financial success, you'll discover smarter, more efficient ways to build your wealth. Ways that can set you apart from the majority of people. Traditional wealth building advice is often focused on slow, incremental progress. Save a percentage of your income, invest in a diverse portfolio, and hope for the best. But in today's fast-paced world, relying on traditional methods isn't enough. That's where the concept of hacking wealth comes in. Hacking wealth is about being strategic, using unconventional methods to accelerate your financial growth in ways that most people overlook. It's about leveraging opportunities, understanding how money really works, and making smarter decisions that build wealth faster. Let me give you an example. Imagine a person who's just starting out with a small investment of $1,000. Instead of putting that money into a traditional savings account or an average stock, they decide to research emerging markets, uncover opportunities in a new technology, and make a calculated investment in something innovative. Fast forward a few years, and that initial $1,000 investment turns into a small fortune. Why? Because they didn't just follow conventional wisdom, they identified trends, took risks, and invested in something that was largely overlooked by the majority. By thinking differently and acting strategically, they were able to multiply their money far more than someone who simply followed the traditional wealth-building route. This audiobook will guide you through exactly how to think like that investor. You'll learn little-known strategies and powerful techniques that you can apply to your own financial journey. From leveraging the power of compounding to understanding alternative investments, every chapter will introduce you to a new way of thinking about money and how to make it work for you in smarter, more effective ways. But here's the most important part. Hacking wealth doesn't just rely on knowing the strategies. It also requires a mindset shift. The world of wealth creation is constantly changing, and staying stuck in outdated methods won't get you the results you want. To truly multiply your wealth, you need to embrace new ideas, new ways of thinking, and new ways of acting. This audiobook will challenge you to think beyond the conventional advice you've likely heard 1,000 times. We'll dive into creative solutions, uncover strategies that most people aren't talking about, and empower you to make bold moves in your financial journey. You might be wondering, how do I get started? The key is to stay engaged throughout this audiobook and remain open to fresh ideas and unconventional methods. Every strategy we discuss is grounded in real-world applications and proven techniques, but it will require you to approach your wealth-building efforts with a new perspective. Whether you're starting from scratch or you're looking to accelerate your financial growth, the tools you'll learn here are adaptable and scalable to fit your current situation. Remember, building wealth doesn't have to follow a traditional path. Some of the wealthiest people in the world didn't follow the rules, they made their own. By the end of this audiobook, you'll have a toolbox of wealth-building strategies at your disposal, each one offering a unique way to multiply your money. The power is in your hands. But to unlock that power, you need to take action. Stay open to the possibilities, commit to applying what you learn, and let's begin your journey to financial freedom. Now, let's dive into the strategies that will transform how you view wealth building forever. Keep your mind open, and let the hacks begin. Your path to multiplying your money starts right now. Chapter 1. The Power of Compound Interest. Compound interest is often referred to as the eighth wonder of the world, and for good reason. It's the single most powerful tool for building wealth over time. Unlike simple interest, which only pays you interest on the initial amount you invested, compound interest allows you to earn interest on both the original investment and the accumulated interest. This creates a snowball effect that accelerates the growth of your money. While it may seem like a slow process at first, over time, compound interest becomes an incredibly potent force. The more time you give it, the more powerful it becomes. Let's take a look at how Warren Buffett, one of the wealthiest individuals in the world, has used compound interest to build his fortune. Buffett's investment strategy is rooted in the concept of compound interest. He famously started investing at a young age, and as his wealth grew, the power of compound interest began to work its magic. By reinvesting profits and holding onto investments for the long term, Buffett's wealth compounded over decades. He made his first stock investment at age 11, and by the time he was 30, he had built a significant amount of wealth, much of it thanks to compound interest. His philosophy of investing in quality assets that pay dividends has allowed him to continually reinvest those dividends, which further compound his wealth. His story is proof that the earlier you start, the more time your money has to grow exponentially. But you don't need to be Warren Buffett to harness the power of compound interest. The key is to start early, make regular contributions, and let time do the work for you. Whether you're investing in stocks, real estate, or other assets, the principle remains the same. The longer your money is invested, the more it will grow. If you were to invest $1,000 in a stock that offers an 8% annual return, you'd earn $80 in the first year. But in year 2, you'd earn interest not just on your initial $1,000, but also on the $80 interest from the previous year. Over time, this compounding effect will snowball, and your returns will grow exponentially. One of the most important factors in leveraging compound interest is consistency. If you want to truly benefit from compound interest, you need to make regular contributions to your investments. Whether you're adding a set amount each month or reinvesting dividends, the more you contribute, the more you'll see your wealth grow. Even small, consistent investments can yield massive results over time. For example, if you invest $100 a month into a mutual fund that earns an average return of 8% per year, in 30 years, you'd have accumulated over $200,000. But the magic happens when those dividends and capital gains are reinvested. This allows you to earn returns on your returns, making your wealth grow exponentially. To get the most out of compound interest, it's essential to understand the importance of reinvesting your dividends. Many investors make the mistake of taking their dividends as cash, but this is missing out on a huge opportunity to accelerate wealth creation. By reinvesting dividends into more shares of the same stock or fund, you're adding to your investment and allowing compound interest to work even harder. For example, if you own shares in a company that pays a quarterly dividend, rather than cashing out those dividends, you can reinvest them into more shares of the company. Over time, as your holdings grow, so will your dividends, creating an ever-increasing cycle of growth. This same principle applies to real estate investments. When you invest in rental properties, you can use the rental income to pay down the mortgage and reinvest in additional properties. As you accumulate more properties, your rental income grows, and you can use that to leverage even more investments. Real estate, like stocks, benefits from compound interest when you reinvest your profits. In fact, many successful real estate investors, including Donald Bren and Sam Zell, have used this very strategy to build vast property empires. It's also important to note that the earlier you start, the better. Compound interest requires time to work its magic, so the sooner you begin, the more time your investments have to grow. Imagine two people. One starts investing $100 per month at age 25, while the other starts at age 40. Even though the second person invests for 15 years longer, the person who started at 25 will likely have more money in the long run, simply because of the power of compound interest. Starting early gives your money more time to grow, so even if you're only able to invest small amounts at first, you can still accumulate significant wealth over time. In addition to investing early and making consistent contributions, another strategy for maximizing compound interest is by minimizing fees. Many investment accounts, especially those with mutual funds or exchange-traded funds, ETFs, charge management fees. While these fees may seem small, they can significantly reduce the power of compound interest over time. A 1% fee may not seem like much at first, but over several decades, that small fee could eat away at a substantial portion of your returns. Always be mindful of fees when choosing where to invest your money. There's no denying that the power of compound interest is one of the most effective wealth-building tools at your disposal. By starting early, contributing regularly, and reinvesting your dividends, you can watch your wealth grow exponentially over time. The beauty of compound interest is that it rewards patience. While the results may not be immediate, over time, they'll be undeniable. Just look at Warren Buffett, whose wealth has grown largely due to his consistent reinvestment and long-term strategy. By applying the same principles he used, you too can harness the power of compound interest to build substantial wealth. To summarize, compound interest is the most powerful tool for wealth building. It works best when you start early, make consistent contributions, and reinvest your earnings. Whether you're investing in stocks, real estate, or any other asset, the magic of compound interest is available to you. Stay disciplined, reinvest your dividends, and watch your wealth grow over time. The earlier you start, the more time your investments have to compound, and the more money you can make in the long run. If you're enjoying this audiobook so far, please hit the like button and subscribe to my channel for more insightful content. Also, don't forget to check the video description for some valuable tools and resources to help you on your wealth journey. Now let's get back to it. Chapter 2. Maximizing investment returns with the right asset allocation. When it comes to building long-term wealth, diversification is one of the most important concepts to understand. The idea is simple. By spreading your investments across various asset classes, you reduce the risk of losing everything when one asset performs poorly. Diversification allows you to weather the storm of market volatility while positioning yourself for higher returns over time. But it's not just about spreading your investments, it's about allocating them in a way that aligns with your financial goals and risk tolerance. The first step in maximizing investment returns is understanding the different types of assets and how they work. Stocks are typically the most volatile but can offer the highest returns in the long run. Bonds, on the other hand, tend to be more stable but offer lower returns. Real estate is another solid asset class that can provide both income, through rental properties, and appreciation, through long-term property value increases. Alternative investments, such as cryptocurrencies and private equity, offer higher risk but can yield outsized returns for those willing to take on the volatility. An effective investment strategy involves allocating your money across these different asset classes in a way that balances risk and reward. The classic method for doing this is through a diversified portfolio, which includes a mix of stocks, bonds, real estate, and perhaps even alternative investments like crypto. The key is finding the right balance for you. What is your risk tolerance? What are your financial goals? By answering these questions, you can determine the optimal allocation for your portfolio. Let's take a look at an example of how diversification works in practice. Consider a hypothetical investor who has $100,000 to invest. They decide to allocate their money in the following way: 60% in stocks, 20% in bonds, 10% in real estate, and 10% in alternative investments, like cryptocurrency. Over the years, their portfolio grows at an average annual rate of 7%. In a typical market, stocks may have some years of strong growth but also experience periods of significant losses. Bonds, however, remain stable and provide regular income. Real estate appreciates in value over time, while cryptocurrencies experience large price swings but can offer substantial gains during bull markets. By maintaining this diversified portfolio, the investor is able to capture the higher growth potential of stocks and real estate while limiting the overall risk with the stability of bonds. The crypto investments, although high risk, have the potential for outsized returns during a market boom. As a result, the investor's portfolio beats inflation over time, growing steadily while staying protected against market downturns. In other words, diversification allows this investor to maximize their returns while minimizing the chances of catastrophic losses. Of course, asset allocation isn't a one-size-fits-all strategy. It's important to consider your own risk tolerance and financial goals when determining how to allocate your investments. If you're younger and have a longer time horizon, you may be more willing to take on risk by allocating more to stocks and alternative investments like cryptocurrency. If you're closer to retirement, you might want to shift more of your investments into bonds or real estate, which provide more stability and less volatility. The key is to align your portfolio with your specific financial needs and time frame. One common mistake that many investors make is being too aggressive or too conservative in their asset allocation. For example, some investors pour all their money into stocks, thinking that's the best way to maximize returns. While stocks have the potential for high returns, they also come with a higher degree of risk. On the other hand, some investors may opt for a completely conservative portfolio, allocating all their money to bonds or cash equivalents. While this strategy is safe, it won't offer the kind of returns needed to beat inflation or build substantial wealth over time. The best way to avoid these mistakes is by creating a diversified investment strategy that fits your goals and risk profile. Start by assessing your current financial situation and your long-term goals. Are you saving for retirement? Are you looking to buy a home in the next few years? The answers to these questions will help you determine your time horizon and risk tolerance. Once you have a clear picture of your financial situation, you can begin to allocate your investments accordingly. One important aspect of asset allocation is regular rebalancing. Over time, your portfolio's value will fluctuate due to market conditions. For example, if stocks have a particularly strong year, your portfolio may become too heavily weighted in stocks compared to your desired allocation. Rebalancing involves adjusting your investments back to the target allocation by selling some of the overperforming assets and buying more of the underperforming ones. This process helps maintain your desired risk level and ensures that you stay on track with your financial goals. Rebalancing also offers the opportunity to take advantage of market conditions. If stocks are performing particularly well, it might make sense to sell some of your stock holdings and allocate the proceeds to other asset classes, like bonds or real estate, that may be undervalued. This can help you buy low and sell high, increasing your overall returns in the long run. There are several tools available to help you manage your asset allocation and rebalance your portfolio. Many online brokers, such as Vanguard, Fidelity, and Charles Schwab, offer automatic rebalancing for retirement accounts, making it easy to maintain a diversified portfolio without needing to do the work yourself. Robo-advisors like Betterment and Wealthfront also provide automated portfolio management based on your risk tolerance and financial goals. These tools can help ensure that your investments stay on track, even if you're busy with other priorities. If you're more hands-on with your investments, there are a variety of online tools available for tracking your asset allocation. Tools like Personal Capital and Mint can help you track your investments and monitor your portfolio's performance. Many of these tools also allow you to visualize your asset allocation, making it easier to see if you need to rebalance your portfolio. In conclusion, maximizing investment returns starts with understanding the power of asset allocation and diversification. By spreading your investments across stocks, bonds, real estate, and alternative assets, you can minimize risk while positioning yourself for higher returns. Whether you're a seasoned investor or just starting out, understanding the importance of asset allocation will help you build a portfolio that works for you. Start by assessing your goals and risk tolerance, and use the right tools to manage and rebalance your portfolio regularly. With a well-allocated portfolio, you can weather market volatility, beat inflation, and set yourself up for long-term wealth. Chapter 3. Using leverage to accelerate wealth building. Leverage is one of the most powerful tools available to investors looking to accelerate their wealth building journey. In simple terms, leverage involves using borrowed money to increase the potential returns on an investment. The concept may seem risky at first, but when used strategically, leverage can help you grow your wealth faster than relying solely on your own capital. It's like using a lever to lift something heavy. By applying a small amount of force, you can move something much larger. The power of leverage lies in its ability to magnify returns. When it comes to investing, there are two types of debt: good debt and bad debt. Good debt is used to fund investments that have the potential to generate returns that exceed the cost of borrowing. Bad debt, on the other hand, is typically used for consumption and doesn't produce income. Credit card debt and personal loans for things like vacations or gadgets fall into the bad debt category. These types of debt can quickly spiral out of control and prevent you from building wealth. Good debt, when used properly, can be a key strategy in building wealth. This is what we refer to as leverage. A real-world example of how leverage can build wealth comes from the world of real estate. Many successful real estate investors use leverage to scale their portfolios. Take the case of an investor who buys a property for $200,000. Instead of paying for the property entirely out of pocket, they put down a 20% deposit, $40,000, and borrow the remaining $160,000 through a mortgage. Over time, if the value of the property appreciates by 5% annually, the property could be worth $210,000 after 1 year. The investor's equity has increased by $10,000, but they only had to invest $40,000 of their own money. This is the power of leverage. With a relatively small initial investment, the investor's return on equity is significantly higher than it would have been if they had used their own capital to buy the property outright. Using leverage in real estate can be a game changer, but it's important to understand the risks involved. While leverage can increase potential returns, it can also magnify losses if the investment doesn't perform as expected. For example, if the property's value were to drop by 5%, the investor would lose more than their initial $40,000 investment. This is why it's critical to approach leverage with caution. Before using borrowed money, make sure you understand the risks and have a plan for how to handle potential downturns in the market. In addition to real estate, leverage can be used in business and the stock market. In business, entrepreneurs often use leverage to fund growth. Instead of funding all business operations with personal savings, they might take out a loan or seek investment to grow their company. This allows the business to scale faster than if it relied solely on the owner's capital. For instance, consider a startup that needs $100,000 to launch a product. Instead of using personal savings, the business owner takes out a loan or raises funds from investors. The product launch is successful, and the business generates enough profit to repay the loan and create substantial returns for the owner. This allows the entrepreneur to scale their business without having to wait years to accumulate the necessary funds. In the stock market, leverage is often used through margin trading. This involves borrowing money from a broker to buy more shares of a stock than you could afford with your own capital. For example, if you have $10,000 in your brokerage account, you could borrow an additional $10,000 from the broker to buy $20,000 worth of stocks. If the stock price increases, your profits are magnified because you've essentially doubled your exposure to the market. However, if the stock price decreases, your losses are also magnified, and you'll owe the broker more than you initially invested. Margin trading can be a great tool for experienced investors, but it's not without its risks. When using leverage, it's crucial to understand your risk tolerance and ensure that the debt is manageable. If you're just starting out, it's best to use leverage cautiously and only in situations where the potential rewards outweigh the risks. Keep in mind that borrowing money comes with fixed costs, whether it's an interest rate on a mortgage, loan payments for a business, or margin interest on a stock investment. These costs can add up over time, so it's important to calculate whether the potential return is worth the cost of borrowing. One practical tip when using leverage is to ensure that you have a reliable income stream or an emergency fund in place. If you're using leverage to invest in real estate or start a business, ensure that you have the cash flow to cover the loan payments, property taxes, and other costs associated with the investment. This will help you avoid getting caught in a financial bind if your investment doesn't perform as expected. Similarly, when margin trading, make sure you have enough funds to cover the margin call if the market moves against you. Having a financial cushion will give you the breathing room needed to weather any downturns without risking your entire investment. Another important strategy when using leverage is to invest with a long-term perspective. Leverage works best when you give it time to generate returns. Short-term fluctuations in the market or the value of an asset shouldn't cause you to panic or sell prematurely. Stay focused on your long-term goals and allow your leveraged investments to compound over time. Here are some final tips to keep in mind when using leverage to accelerate wealth building. Start small. If you're new to leverage, start with smaller amounts and gradually increase your exposure as you gain experience. Monitor your debt levels. Keep track of your borrowing and ensure that it's manageable relative to your assets and income. Diversify your investments. Don't rely solely on leverage in one area. Spread your risk across different assets to mitigate potential losses. Understand the costs. Factor in interest rates, loan fees, or margin costs when determining whether to use leverage. Have an exit strategy. Know when to cut your losses if an investment doesn't perform as expected. Having a plan in place will help you make better decisions under pressure. In conclusion, leverage is a powerful tool that can accelerate wealth building, but it must be used carefully. Whether you're using leverage in real estate, business, or the stock market, the key is to understand the risks involved and to borrow only when the potential returns justify the cost. With proper management and a cautious approach, leverage can help you multiply your money and achieve your financial goals faster than you ever thought possible. Chapter 4. Wealth Building with Passive Income Streams. One of the most powerful ways to multiply your wealth is through passive income, earning money with minimal ongoing effort. While active income, like a job or a business you run day to day, requires constant work and time commitment, passive income allows you to make money while you sleep. It's the key to financial freedom, because once you set up a passive income stream, it can keep paying you without requiring you to actively trade your time for money. In this chapter, we'll explore the different types of passive income and how you can start generating multiple streams to build wealth over time. The importance of passive income lies in its ability to free up your time while continuing to generate cash flow. Whether you're looking to retire early, supplement your current income, or create wealth that outlasts you, passive income is the bridge to making that possible. The concept may sound too good to be true, but when you understand how different types of passive income work, you'll see that it's more achievable than you might think. One of the most common forms of passive income is dividends. Dividends are payments made to shareholders by companies that generate profits. If you own stock in a dividend-paying company, you receive a portion of the profits on a regular basis, usually quarterly. While dividend payments might seem small at first, they can add up significantly over time, especially if you reinvest the dividends back into buying more shares. Take Warren Buffett's strategy, for instance. By investing in dividend-paying companies and reinvesting those dividends, he has turned a relatively small initial investment into billions over decades. Dividend investing allows you to gradually build wealth while having the peace of mind that your income will continue to grow as long as the company performs well. Rental income is another excellent passive income stream. By purchasing real estate and renting it out, you can earn a steady cash flow without having to actively manage the property every day. Many investors choose rental properties because, over time, they can provide both income and long-term appreciation. The key to success with rental properties is finding a property in a location with strong demand and keeping operating costs low. While it's not entirely hands-off, you might need a property manager. Rental income can be a very reliable and growing income stream. For example, someone who purchases a single-family home, rents it out, and uses the rent to cover the mortgage, can earn passive income while the property appreciates. If they buy multiple properties, their income multiplies, and they can continue to scale their wealth. Another form of passive income that has gained significant traction in recent years is royalties. This applies to any intellectual property you own, like books, music, software, or patents. When you create a product and sell the rights to it, you can receive ongoing payments, royalties, for each time the product is sold or used. For example, an author who writes a book and publishes it can earn royalties each time the book sells. Many authors, musicians, and creators use royalties as a way to generate income long after their initial work is completed. Similarly, inventors can patent their creations and earn royalties whenever someone uses or licenses that patent. The beauty of royalties is that once you've created the product, the income comes in passively without requiring additional work on your part. The digital age has also opened the door for a new wave of passive income opportunities through digital products. These can include anything from ebooks and online courses to software or digital art. Once created, these products can be sold over and over with little ongoing effort. For example, a content creator could create an online course teaching a specific skill, like photography or coding, and sell it on platforms like Udemy or Teachable. Once the course is created and uploaded, it can continue to generate income without requiring the creator to do any additional work. Similarly, someone could create an ebook or digital printables that people can download automatically. The beauty of digital products is that they're scalable. You can sell them to an unlimited number of people, and the only limit to your income is your ability to market the product. A great example of someone leveraging passive income to achieve financial freedom is Pat Flynn, a successful online entrepreneur. Pat started his business by creating an online course, and as his audience grew, he expanded into creating multiple passive income streams. Through affiliate marketing, selling online courses, and generating revenue from his podcasts, Pat Flynn was able to generate enough passive income to retire from his full-time job and focus on his entrepreneurial ventures. His success story demonstrates that passive income isn't just for the wealthy or for people with a lot of capital to start with. It's about using your skills and creativity to build income streams that run in the background while you focus on other things. Now, you might be thinking, how can I start creating passive income? The good news is, there are many ways to get started, and you don't need a large amount of capital up front to begin building your passive income empire. Here are a few practical steps to get started with passive income. Identify your skills and interests. Start by thinking about what you can offer that others might pay for, whether it's a digital product like an ebook or a service like online coaching. Create your first passive income stream. For many, the best place to start is with a digital product. Create something you're passionate about and get it online. Platforms like Amazon for books or Teachable for courses make it easy to start. Reinvest your earnings. Once your first stream is up and running, reinvest your earnings into creating additional streams. For example, use the income from your online course to buy real estate or invest in dividend-paying stocks. Scale over time. As you become more comfortable, scale your passive income streams by automating processes, increasing marketing efforts, or diversifying your portfolio of income-producing assets. There are also several tools and platforms that can help you generate passive income. Peer-to-peer lending platforms like Lending Club and Prosper allow you to lend money to individuals or small businesses in exchange for interest payments, which is a form of passive income. Dividend investing platforms, such as M1 Finance and Robinhood, allow you to buy stocks that pay dividends, making it easier to build a passive income portfolio. Creating online courses can be done with tools like Teachable, Udemy, and Thinkific, which offer everything you need to create, market, and sell your courses. In conclusion, passive income is one of the most powerful wealth-building strategies available to anyone, regardless of their starting point. Whether it's through dividends, rental income, royalties, or digital products, creating passive income streams allows you to make money without the need for constant active involvement. The key is to start small, stay consistent, and gradually scale your efforts over time. By building multiple streams of passive income, you'll be well on your way to achieving financial freedom and multiplying your wealth. Chapter 5. The Art of Smart Tax Strategies. Taxes are a silent killer of wealth. While it may not be immediately obvious, the taxes you pay on your income, investments, and properties can take a substantial chunk out of your wealth over time. Without a smart strategy in place, Taxes can eat away at your returns, making it much harder to build the wealth you desire. Fortunately, there are legal ways to minimize taxes and keep more of your hard-earned money working for you. In this chapter, we'll explore how taxes impact your wealth and how you can use strategies to reduce your tax liabilities. To understand the importance of tax strategies, consider this. Every dollar you pay in taxes is a dollar that doesn't go toward building your wealth. Imagine you earn $100,000 per year, and after taxes, you only get to keep $70,000. If you're not using any tax strategies to minimize your liabilities, that's $30,000 that could have been invested or used to generate additional income. Over the years, that money could compound and contribute to building significant wealth, but instead, it's lost to the government. That's why it's so important to plan your tax strategy effectively. One of the most powerful tools for reducing your tax liabilities is using tax-deferred accounts like 401ks and IRAs. These accounts allow you to contribute money before taxes are taken out, effectively lowering your taxable income for the year. For example, if you contribute $10,000 to a 401k, you don't pay taxes on that amount in the current year. Instead, your money grows tax-deferred, meaning you won't pay taxes on the earnings until you withdraw the money, typically in retirement. This gives your investments more time to grow, as the full amount can be reinvested, compounding over the years. Another benefit of tax-deferred accounts is that they encourage long-term investing. The tax advantages make it more appealing to invest in these accounts for the long haul, rather than withdrawing funds early. If you withdraw money from a 401k or IRA before you reach retirement age, you may face penalties and additional taxes, which incentivizes you to keep the money in the account and allow it to grow. This aligns perfectly with wealth-building strategies that focus on long-term gains rather than short-term profits. Another valuable tax strategy is utilizing tax credits and deductions. Tax credits directly reduce your tax bill, while deductions lower the amount of income that is taxed. For instance, if you qualify for the Earned Income Tax Credit, EITC, or Child Tax Credit, you can directly reduce the amount you owe the government. Deductions like those for mortgage interest or charitable contributions lower your taxable income, reducing the overall amount of tax you have to pay. These deductions may seem small, but they can add up significantly over time, particularly if you're making large charitable donations or paying a mortgage. Municipal bonds are another tax-advantaged investment that can help you reduce your tax liabilities. These are bonds issued by local or state governments to fund public projects, and the interest you earn from them is often exempt from federal and state taxes. While municipal bonds tend to offer lower returns than other investments, they can be a great way to reduce your taxable income, especially if you're in a high tax bracket. Over time, the tax savings can add up, and you'll be able to keep more of your earnings. Let's look at an example of someone who successfully reduced their tax liabilities through smart planning. Take the case of a successful entrepreneur who owns several businesses. This entrepreneur is in a high tax bracket, but by using tax-deferred retirement accounts and investing in municipal bonds, they were able to significantly reduce their taxable income. In addition to these strategies, they also took advantage of tax deductions available for business expenses, such as office supplies, travel costs, and equipment. By working with a tax professional, they created a comprehensive tax plan that allowed them to legally minimize their tax burden and reinvest the savings into their businesses and investments, accelerating their wealth-building process. While there are many ways to reduce taxes, it's essential to understand that tax laws are constantly changing, and strategies that work today may not be effective in the future. That's why it's important to stay informed about the latest tax laws and work with a tax professional who can help you navigate the complexities of the tax system. Tax professionals, including accountants and financial planners, are invaluable resources for anyone looking to build wealth through smart tax strategies. They can help you identify tax-saving opportunities, make sure you're in compliance with the law, and create a plan that maximizes your wealth-building potential. Working with a tax professional also gives you peace of mind, knowing that your taxes are being handled by someone with expertise in the field. A good tax professional can spot deductions and credits you might have missed, help you plan for future tax liabilities, and even suggest ways to structure your income and investments to minimize taxes over the long term. Without the right guidance, it's easy to miss out on opportunities that could save you thousands of dollars over the years. In addition to working with professionals, there are other tools and strategies that can help you stay on top of your taxes and manage your wealth. One such tool is tax software like TurboTax or H&R Block, which can help you file your taxes efficiently and identify potential savings. These platforms are designed to walk you through the process of tax filing and ensure that you take advantage of every deduction and credit available to you. However, if you're dealing with more complex financial situations or business ownership, it's still a good idea to consult with a tax professional. Another tool to consider is tax-deferred retirement accounts like 401ks and IRAs. Both of these accounts allow you to invest for the future while reducing your current taxable income. For those who are self-employed or have side income, SEP IRAs and solo 401ks offer even higher contribution limits, allowing you to save more for retirement while lowering your taxable income. In conclusion, smart tax strategies are essential for multiplying your money and building wealth over time. By using tax-deferred accounts, taking advantage of tax credits and deductions, investing in tax-advantaged assets like municipal bonds, and working with tax professionals, you can minimize your tax burden and keep more of your hard-earned money. Taxes may always be a part of life, but with the right strategies in place, you can ensure they don't eat into your wealth-building efforts. Start planning your tax strategy today, and let the power of tax savings help you accelerate your journey to financial freedom. Chapter 6. Scaling with Business Investments. Business ownership and investments in small businesses or startups represent some of the most powerful ways to multiply wealth. Unlike traditional investments like stocks or bonds, business investments offer the unique opportunity to directly influence and benefit from growth. When you invest in a business, especially early on, you're not just a passive shareholder, you're helping shape the company's trajectory. Business ownership can be a vehicle for massive wealth generation if approached strategically, with the right mindset and a clear understanding of how to scale and maximize returns. One of the greatest success stories in recent history is the story of individuals who invested in companies like Apple or Amazon in their early years. Take Jeff Bezos, for instance. While most people saw Amazon as just another online bookstore, early investors recognized the massive potential for growth. The returns for those who invested early were monumental. A $10,000 investment in Amazon in 1997, when the company went public, would have turned into over $18 million by 2021. This staggering growth was fueled not just by luck, but by strategic decisions, innovative business models, and the ability to scale quickly. Bezos, Steve Jobs, and other entrepreneurial giants understood that their businesses could grow exponentially, and they built systems and strategies around that vision. The power of early-stage investments lies in their ability to scale rapidly. The earlier you invest in a company, the more significant your returns can be, given that the business is still in its formative stages and hasn't yet reached its full potential. But investing in startups or small businesses isn't without its risks. Many startups fail, and even the most successful businesses can experience volatility. That's why understanding how to evaluate these investments is crucial. The first step in evaluating a business investment is understanding its potential for growth. What makes this business scalable? Does it have a unique product or service that can reach a wide audience? What's the market demand for it, and how well does the business meet that demand? Startups that fill an untapped need or solve a significant problem have an inherent advantage, as they are more likely to capture and retain customers. Think about the early days of companies like Facebook. Initially, it was just a social network for college students, but its ability to scale quickly and expand to new markets made it a global platform, and those early investors saw huge returns. Another critical element in evaluating a business investment is the management team. The founders and the leadership team play an outsized role in determining the success or failure of a business. A great product means little if it's not backed by a strong team that can execute and adapt to challenges. Look for companies with visionary leaders who have a proven track record of success. Founders who are passionate, resourceful, and open to feedback are often the ones who are able to pivot and adjust their business models as the market demands. When evaluating any business investment, it's also important to assess the financial health of the business. Are they profitable, or are they heavily reliant on funding? Do they have a clear and sustainable revenue model, or are they in the growth at all costs phase? For example, a business that burns through cash quickly might seem exciting, but the risk of it running out of money before it becomes profitable could be a deal breaker. On the flip side, businesses that generate consistent cash flow and can demonstrate sustainable growth over time are often lower risk and present better long-term opportunities for investors. Once you've decided to invest in a business, the next step is scaling the business and creating long-term value. The ability to scale a business quickly is one of the key factors in turning a small investment into a large fortune. Scaling a business involves expanding its operations, increasing its customer base, and enhancing its profitability. However, scaling isn't just about growing in size, it's about growing strategically. A successful business scaling strategy often involves expanding product lines or services, entering new markets, or improving operational efficiency. Take the example of Apple, which successfully scaled by diversifying its product offerings, from computers to smartphones, tablets, and wearables. Apple's ability to expand into new categories while keeping its core product, its computers, relevant in the market helped it grow into one of the largest companies in the world. They also scaled their operations globally, taking advantage of different markets and economies of scale to increase profitability. Another key component of scaling is investing in technology and automation. Many businesses start small, but as they grow, they need to become more efficient. Automation can be a game changer in this regard. Using technology to automate processes, streamline customer service, or improve inventory management can significantly reduce operational costs and free up valuable resources to focus on other aspects of the business. By embracing technology and innovation, businesses can scale faster and more effectively, ultimately driving more significant returns for investors. While scaling can lead to massive rewards, it's essential to be mindful of the risks involved. Many businesses fail because they attempt to scale too quickly or without proper infrastructure in place. Scaling a business is a delicate balance. If you expand too aggressively, you might overextend your resources, damage the customer experience, or create operational inefficiencies. However, if you scale too slowly, you risk missing out on opportunities and allowing competitors to take the lead. The key is to grow in a controlled, sustainable way that maximizes returns while maintaining operational integrity. One strategy for managing the risks of scaling is diversification. Just as diversifying your investment portfolio can reduce risk, diversifying a business's revenue streams can provide stability as it scales. For example, a business that initially relied on one product might diversify into complementary products or services to hedge against fluctuations in the market. By expanding its offerings, the business becomes more resilient and adaptable in the face of market changes. A practical example of a business successfully scaling and creating long-term value is the story of Airbnb. What started as a simple idea for renting out air mattresses in people's homes became one of the most successful global companies in the sharing economy. Airbnb's success lies in its ability to scale rapidly, tap into new markets, and continuously innovate its service offerings. Its platform connected people looking to rent out space with those looking for affordable accommodation, creating a new revenue stream for homeowners and a new travel option for tourists. Airbnb's focus on scaling both geographically and through expanding its service offerings has created massive wealth for its founders and early investors. Investing in businesses and scaling them for long-term success involves not only identifying high-growth opportunities but also being strategic about how you grow and manage that growth. By carefully evaluating the potential of a business, supporting strong leadership teams, and using smart strategies to scale, you can turn your business investments into wealth-building assets. Business investments are powerful because they offer the opportunity to get in on the ground floor of companies that can disrupt industries and generate massive returns. But it's important to approach them with the right strategies, cautious optimism, and a long-term view. Chapter 7. The Power of Networking and Relationships in Wealth Building. Networking is one of the most effective and underrated tools for wealth building. While traditional methods of building wealth, like saving and investing, are important, cultivating relationships can be the key that unlocks significant financial opportunities. By connecting with the right people, you can gain access to investment opportunities, partnerships, and valuable knowledge that you might not have come across otherwise. Wealth is not just built on assets but on the relationships you create and nurture along the way. Successful entrepreneurs and investors know the power of a strong network. For example, Mark Zuckerberg's rise to fame and fortune wasn't just about creating Facebook. It was also about surrounding himself with the right people. One key figure in his story is Sean Parker, co-founder of Napster. Parker introduced Zuckerberg to potential investors, which ultimately helped Facebook scale. Similarly, Zuckerberg's ability to connect with influential figures like Steve Jobs, Reid Hoffman, and other successful entrepreneurs gave him valuable guidance and insight. Zuckerberg didn't build Facebook alone. His network of advisors, mentors, and investors played a crucial role in his success. Building a network of influential people can open doors to opportunities that otherwise would be impossible to access. In the world of investing, these relationships can lead to tips on lucrative opportunities, partnerships with other investors, and introductions to new markets. For example, a business owner who knows a successful venture capitalist could have their business pitched to investors, gaining funding to scale. An individual investor with a strong network might hear about investment opportunities in early-stage startups or real estate before the general public does. Networking allows you to tap into insider knowledge, increasing your chances of making smarter, more profitable decisions. However, building a network is not just about finding people who can help you, it's about offering value in return. Networking isn't a one-way street. It's about creating mutually beneficial relationships where both parties can grow. It's important to be clear about what you can offer others. Do you have a particular skill set, expertise, or knowledge that others might find valuable? Are you able to introduce them to other influential people? Networking is about giving as much as you get. When you help others succeed, they're more likely to want to help you in return. One practical tip for building meaningful connections is to always approach networking with genuine curiosity and an interest in the other person. Don't just focus on how they can help you. Learn about their challenges, experiences, and what they value. People can sense when someone is genuinely interested in them and not just looking for a transaction. By focusing on building authentic relationships, you can create a network that is not only valuable for your career and business but also meaningful on a personal level. It's also crucial to surround yourself with individuals who have similar values and goals. While it's important to network widely, it's equally important to build relationships with people who align with your vision for wealth building. For instance, if you're focused on building a business empire, connecting with other entrepreneurs who have scaled their companies successfully will provide valuable insights into the challenges and opportunities you may face. Likewise, if you're an investor, connecting with other investors can help you identify new opportunities, share strategies, and learn from their experiences. In addition to personal connections, online networking platforms can be incredibly powerful. LinkedIn, for example, is a valuable tool for connecting with other professionals and entrepreneurs who share your interests. There are also industry-specific networking groups, conferences, and online communities where you can interact with experts and learn from others in the field. Don't just passively observe, engage actively. Post thoughtful comments, share relevant content, and reach out to people whose work you admire. Over time, you can build a solid network that will help support your journey to wealth. When building relationships in business or investing, reputation and integrity are paramount. Word of mouth is powerful in the business world, and your reputation is one of your most valuable assets. Building trust takes time, but it can be destroyed in an instant. Always follow through on commitments, be transparent, and be someone who others can rely on. This reputation will pay dividends in the long run. People are more likely to refer you for new opportunities, invest in your business, or offer advice when they know they can trust you. Your network's value lies not only in the financial opportunities it brings but also in the wisdom and support it provides. Mentorship is one of the most valuable benefits of a strong network. Having a mentor who has already walked the path you want to follow can save you years of trial and error. These individuals offer insight into what works, what doesn't, and how to navigate challenges. As your network grows, you'll also have the opportunity to pay it forward by mentoring others, further strengthening your position and giving back to the community. Finally, always be mindful of the relationships you cultivate and maintain. It's not about having the most contacts, but about having the right contacts. Invest time in nurturing relationships with those who can provide long-term value. Whether they are mentors, peers, or industry experts, keeping in touch and finding ways to add value to their lives will build a network that supports you throughout your journey. In summary, the power of networking cannot be overstated when it comes to wealth building. Relationships provide access to valuable opportunities, knowledge, and partnerships that are often the key to significant financial growth. Networking isn't just about taking, it's about giving, building trust, and offering value. By surrounding yourself with the right people and engaging with them authentically, you can create a powerful network that accelerates your path to wealth. Whether you're an entrepreneur, investor, or someone looking to scale their financial portfolio, the people you know, and the value you bring to them, will play a pivotal role in your success. Chapter 8. Real Estate. A tried and true wealth building strategy. Real estate investing is often hailed as one of the most reliable ways to build long-term wealth. It's a tangible, physical asset that tends to appreciate over time and can generate steady income through rents, sales, and tax benefits. The beauty of real estate lies in its versatility. Whether you're looking to generate passive income, take advantage of market appreciation, or build equity, real estate provides numerous avenues for growing your wealth. Unlike stocks or bonds, real estate is a hard asset that you can physically control, making it a popular choice for investors looking for stability and long-term value. There are several types of real estate investments, each offering different benefits and levels of involvement. One of the most common forms of real estate investment is rental properties. Owning rental properties allows you to generate consistent, passive income from tenants who pay you rent each month. This steady income stream can serve as a source of cash flow, and over time, as the value of the property appreciates, you also benefit from capital gains. Additionally, rental properties offer various tax deductions, such as depreciation and expenses for repairs, property management, and mortgage interest. These advantages make rental properties an attractive option for those looking to build wealth over time. Another way to invest in real estate is through flipping properties. This strategy involves purchasing properties below market value, renovating them, and then selling them for a profit. Flipping requires more effort than owning rental properties because it involves both time and money to make the property more appealing to potential buyers. However, the returns can be substantial if done correctly. Investors who flip properties often rely on market trends and home improvement knowledge to identify undervalued properties, make improvements that increase the property's value, and sell quickly for a profit. The key to successful flipping is knowing when to buy, when to improve, and when to sell. Real estate investment trusts, REITs, offer another way to get involved in real estate without owning physical properties. REITs are companies that own, operate, or finance income-producing real estate. By investing in a REIT, you essentially buy shares in a company that manages a portfolio of properties, such as office buildings, shopping centers, and apartments. REITs offer the advantage of diversification and liquidity. Since they are traded on the stock market, they are easier to buy and sell than physical properties. REITs also provide exposure to different types of real estate markets, from residential to commercial. However, they often come with management fees and lower potential returns compared to direct ownership of properties. Another popular real estate investment option is commercial real estate. Commercial properties, such as office buildings, industrial spaces, and retail stores, are typically leased to businesses and offer higher income potential than residential properties. Commercial real estate is also less volatile than residential markets, with long-term leases providing a stable income stream. However, commercial real estate investments tend to require more capital to get started, and property management can be more complex. The potential for significant returns is high, but so are the risks. A prime example of a real estate investor who successfully scaled their wealth is Grant Cardone. Starting with a single small investment in a property, Cardone used leverage and strategic property management to grow his portfolio into a multi-billion-dollar real estate empire. He initially focused on smaller residential units, but as his experience and capital grew, he expanded into larger, more profitable commercial properties. Today, Cardone's portfolio includes thousands of units across multiple states, and he continues to reinvest the proceeds into new ventures. Cardone's story is a perfect example of how real estate can be used as a vehicle for wealth building when you use leverage and a long-term investment strategy. For beginners, one of the biggest challenges in real estate investing is getting started with minimal capital. However, there are financing options available to make it easier to enter the market. Many investors use leverage, borrowing money through a mortgage or other financing methods, to purchase properties without having to use all of their own capital. Some creative financing options include hard money loans, seller financing, and partnering with other investors to pool resources. Many successful real estate investors start with little money down by using these strategies and leveraging their properties for further investments. Additionally, house hacking is a strategy that allows investors to enter the real estate market with minimal upfront costs. House hacking involves purchasing a property, living in one part of it, and renting out the other parts to cover the mortgage. For example, buying a duplex, living in one unit, and renting out the other can create a situation where your tenants essentially pay your mortgage, allowing you to build equity and cash flow with very little personal financial investment. This is an effective way to break into real estate investing without requiring significant capital upfront. Another essential aspect of real estate investing is property management. Whether you manage properties yourself or hire a professional property manager, effectively managing your real estate portfolio is crucial for maximizing returns. A good property manager will take care of everything from collecting rent to handling repairs, while ensuring that your properties are occupied by reliable tenants. However, if you choose to manage your properties yourself, there are various tools and systems available to help streamline the process, such as property management software, online rent collection platforms, and maintenance request systems. One of the key tax benefits of real estate investing is depreciation. Depreciation allows you to deduct the cost of the property over time, which can offset the rental income you receive and reduce your overall taxable income. The IRS allows real estate investors to depreciate their properties over a 27.5-year period for residential properties or 39 years for commercial properties. This tax deduction is a powerful tool for reducing your tax burden and increasing cash flow, allowing you to reinvest those savings into new properties or other investments. In addition to the financial rewards, real estate also provides significant long-term wealth building potential. As properties appreciate over time, you build equity in your investments. The longer you hold onto the property, the more valuable it becomes, especially if you make improvements that increase its worth. Real estate is also a hedge against inflation. While the value of stocks or bonds may fluctuate, real estate often appreciates steadily over time, providing a stable source of wealth accumulation. Additionally, the rental income from properties can serve as a steady stream of cash flow, offering financial security and passive income. In conclusion, real estate is a tried and true strategy for building long-term wealth. Whether you're investing in rental properties, flipping homes, or diversifying through REITs, real estate offers numerous avenues for generating income and building financial security. While getting started in real estate may require creativity and some initial capital, the potential returns and tax benefits make it one of the most reliable wealth building strategies available. With the right knowledge, financing options, and management strategies, real estate can be an incredibly effective way to multiply your money and achieve long-term financial success. Chapter 9. The Power of Mindset. Thinking like a wealth builder. When it comes to wealth creation, mindset is everything. The way you think about money can either propel you toward financial success or hold you back from reaching your true potential. Millionaires and billionaires share a common trait: they think differently about money. They don't see it as a limited resource or something to be feared. Instead, they view it as a tool that can be used to create more opportunities, more freedom, and more wealth. Your mindset, more than any specific strategy or investment, plays a significant role in determining your financial future. The first major shift that wealth builders experience is moving from a scarcity mindset to an abundance mindset. A scarcity mindset is the belief that resources are limited, that there's only so much money, success, or opportunity to go around. People with a scarcity mindset often find themselves focusing on what they lack, creating a sense of fear and competition. They hold on to money tightly, afraid of losing it, and fail to take risks that could lead to growth. On the other hand, an abundance mindset is the belief that resources are plentiful and that wealth can be created, shared, and expanded. People with this mindset see opportunities everywhere and believe that by creating value and helping others, they can grow their own wealth. Instead of focusing on what they don't have, they focus on what they can create. This shift in thinking is crucial for long-term success because it opens up new possibilities, encourages risk-taking, and drives action toward financial goals. Let's look at the example of Sarah, a woman who transitioned from living paycheck to achieving financial freedom. In her early 20s, Sarah struggled with debt and constantly worried about money. She had a job that barely covered her living expenses and couldn't seem to get ahead. However, one day, she realized that her financial struggles were rooted in her mindset. She had been focusing on her lack of resources and was afraid to take risks. Determined to change her life, Sarah started reading books on personal finance and wealth building. She began to shift her mindset, learning that wealth was not about being lucky or having a big inheritance. It was about making smart decisions and taking advantage of opportunities. With this new mindset, Sarah started setting clear goals. She focused on paying off her debt, building a small investment portfolio, and looking for ways to increase her income. Over time, Sarah's financial situation improved. She started a side business, invested in low-cost index funds, and kept expanding her skills and network. The more she believed in the possibility of creating wealth, the more opportunities seemed to appear. After several years of hard work and persistence, Sarah had not only eliminated her debt but had also built enough wealth to live comfortably without worrying about money. The key to her transformation was her mindset shift, from seeing money as scarce to realizing that she could create wealth and opportunities through her actions. Developing a wealth-oriented mindset is not an overnight process, but it is entirely achievable with the right habits and practices. One of the first steps is setting clear financial goals. Having specific, measurable, and time-bound goals provides direction and focus. Whether it's paying off a certain amount of debt, saving for a down payment on a house, or reaching a specific net worth, having goals keeps you accountable and motivated. Once your goals are clear, you can begin to break them down into smaller, actionable steps. Setting goals is important because it helps you shift from a passive mindset, where you react to life's challenges, to an active mindset, where you proactively take control of your financial future. Self-discipline is another key component of a wealth-building mindset. Wealth is not built by impulsive decisions or by chasing every get-rich-quick opportunity that comes along. It's built through consistent, disciplined actions over time. This means living below your means, saving regularly, investing wisely, and avoiding unnecessary risks. Self-discipline also involves saying no to temptations that might derail your financial progress, such as extravagant purchases or unnecessary debt. The ability to delay gratification and stay focused on your long-term goals is crucial for wealth building. Risk-taking is another habit that wealthy individuals embrace. Wealth is rarely built by playing it safe all the time. While taking unnecessary risks can be dangerous, calculated risks, such as investing in the stock market, starting a business, or investing in real estate, can pay off massively in the long run. Wealthy individuals understand that to achieve significant wealth, they must step out of their comfort zones and take smart risks. This doesn't mean gambling or making reckless decisions, but it does mean having the courage to invest in yourself and your future. Finally, one of the most important aspects of a wealth-oriented mindset is long-term thinking. Wealth is not built overnight, and those who achieve financial freedom understand that it takes time, persistence, and patience. There will be setbacks along the way, but the key is to stay focused on the long-term goal and not get discouraged by short-term challenges. Billionaires like Warren Buffett have spent decades building their wealth, and their success is a result of sticking to their investment strategies and having the patience to see them through. The same principle applies to anyone looking to build wealth. If you focus on creating value, making smart financial decisions, and staying disciplined, you'll be well on your way to long-term financial success. Building wealth is as much about mindset as it is about strategy. The difference between those who achieve financial freedom and those who struggle financially often comes down to how they think about money. By shifting from a scarcity mindset to an abundance mindset, setting clear goals, developing self-discipline, embracing calculated risk-taking, and focusing on long-term thinking, you can begin to build the wealth you've always dreamed of. Wealth building is not just about money. It's about developing a mindset that allows you to see and seize opportunities, take bold actions, and stay committed to your financial goals over the long haul. In conclusion, thinking like a wealth builder is essential for achieving financial freedom. Your mindset shapes your financial outcomes, and by focusing on abundance, taking disciplined actions, and thinking long-term, you can achieve the wealth you desire. It's not about how much money you start with, it's about how you think about and manage money. With the right mindset, anything is possible. We've covered a lot of ground in this audiobook, diving into little-known strategies and practical advice to help you multiply your wealth. From understanding the power of compound interest, to leveraging the right asset allocation, to using leverage in investments, we've unlocked the secrets to building lasting financial freedom. You've learned how to set yourself up for success with passive income, the importance of tax strategies, and the immense potential of real estate as a wealth-building tool. We've also talked about the role of mindset, how shifting from a scarcity mindset to an abundance mindset can change everything. Now, the real work begins. Knowledge without action is just potential waiting to be realized. The next step is taking the information you've learned and applying it in your own life. The wealth-building strategies we've discussed are not just theory. They're proven methods that have helped countless millionaires and billionaires achieve financial freedom. But none of it will work unless you take that first step. Start small. You don't need to have millions of dollars to begin. Start where you are with what you have. It's the consistent actions you take, no matter how small, that will compound over time and lead to massive wealth. Begin by setting clear financial goals, whether that's investing in the stock market, real estate, or starting a side business. Take the lessons you've learned here and start implementing them. Begin to build your asset portfolio, create a network, and practice smart tax strategies. Remember, wealth is a journey, not a destination. Patience, persistence, and long-term thinking will be your greatest allies. It's easy to get discouraged when things don't happen immediately, but the key to wealth building is consistency. Think of it like planting seeds. You might not see the fruits of your labor right away, but with time, those seeds will grow into a strong financial foundation. The path to wealth is not always easy, but with the right steps, it is absolutely possible for anyone. You have the tools, you have the knowledge, now it's up to you to take action. The most successful people didn't wait for the perfect moment. They took the first step, no matter how small, and committed to building their wealth over time. So, take that first step today. Start applying the strategies you've learned, and begin your journey toward multiplying your money. The journey may be long, but it's worth it. Wealth doesn't happen overnight, but anyone who follows the right steps, takes consistent action, and keeps their mindset focused on growth can achieve financial success. Your wealth building journey starts now, so what are you waiting for? Thank you for listening. If you found this audiobook valuable, please hit the like button and subscribe to my channel for more content like this. Be sure to check the video description for tools and resources that can help you take your wealth journey to the next level. Your future starts today. Take action and make it count.